Hello, hello. Today we're going to talk about the importance of building a stock portfolio and how to build one. So we're here with with this other website right here, receiptinvest.com, and we're going to use this website to cover up this topic today. And let's go ahead and start it now. So the importance of a full investment portfolio and how to build one. Okay, so a portfolio resembles a pie of your financial assets as it's filling. Your choice of filling reflects your interests and opens a window to your financial indulgences. Why should you take a close look at your portfolio? So, let's go ahead and start talking about it. So, what can a portfolio hold? A portfolio holds stocks, bonds, cash, and cash equivalents such as ETFs. It can also include other assets that retain value and are a part of a moving market in which they can be sold and traded, like gold, valuable art, real estate, cryptocurrency, and private investments. So this basically that's what a portfolio is. Okay, it can hold up to all of these things to create you a system that generates income from you without you necessarily having to be working for anyone or anybody. So again, that's the main goal of a portfolio. And again, you're investing on companies and on stocks or other things. You can be you can be investing in gold or in companies, investing in the economy of your country or whatever and so on, and you get something in return from it. So, what is the purpose of having a portfolio? I just said that. We're gonna read it again. Portfolios provide a framework for your money. They help you oversee and manage your investments. A portfolio can help you diversify your assets and spread your risk across stocks, bonds, and other types of investments. So, what goes into creating a portfolio? There are two key considerations when creating and maintaining a portfolio. So, the first one is risk tolerance, your capability to tolerate the risk of losing money. So by defining your tolerance to different levels of risks, you'll be able to make reasonable considerations when it comes to the type of investments you make in which companies you invest in. So again, every single one of us, we have our own risk tolerance. So some of us could be a little bit more aggressive, some of us could be a little bit more defensive. So it really comes down to you, to what you want, to your age, to your risk reward ratio, how far you're willing to go for certain things. So it's very personal. There's no right or wrong into creating your portfolio. You create your own right and you create your own wrong. Okay, so you create of what's best and what fits best for your own scenario and for your own personal type of investment thing that you'd like to create. Again, so time horizon. So to time horizon, how long you're planning to hold certain assets for, or assets for. I'm not sure if it's assets or assets. I'm sorry, guys. You should consider the amount of time you have to own specific assets until you need to exit the market. Your time horizon can correlate to your age, time left until retirement, projected returns. I'm not sure, and other factors. So again, this is very personal from person to person. Some people, they like to do for example, if you have a stock portfolio solely, some people, they do buy and hold. What is a buy? What's buy and hold? So buy and hold, so essentially you buying a share of a stock, um, and then you're gonna be earning dividends and yeah, dividends and a small percentage of the share that you have for the rest of your life. So you're actually an investor. So you're investing in the company. The company is going to use this money to to increase their process through what they're doing. So, for example, you're investing in a food company. So they're going to use your money to create a bigger sustainability in their system to help other people to sell their services to other people, and then you're going to run a dividend off of this in exchange for your help for them. So you help them, they help you, and then again, you're an investor, so you're going to be earning passive income for the rest of your life. And that's what buy and hold is. So it's investing in a company forever to learn passive income. All right, but before the passive income, you have to have the active income. So you have to have the money to receive it, right? Let's go. So, what is the difference between buying stocks and buying a portfolio? Buying a stock refers to your decision to hold a share in a corporation after doing an in-depth research about the stock and the company itself. When buying a stock, you have ideally considered all factors of the investment and found it to be worth the risk. So again, It comes down to studying, doing your research, understanding the risks of the operations, understanding how the company works, understanding how much money you're putting into it. Again, are you going to put all your money into this company, and so on and so forth. So it's a little deeper than just buying a stock and waiting for the results. You have to really understand it if you want to take it serious and if you want to live off of the stock market, or at least be at least a little serious about it. So again, it comes down to this. And when it comes to building a portfolio, you don't look only at the performance of the stock in respect to itself or the company. You also take the other financial assets and risks into consideration. As a whole, your investment portfolio is a dynamic asset at your build. It's a dynamic asset hat, or that, right? I think it's that. So that helps you build your financial empire. And here he talks about types of investment portfolio and to consider, and I've already said about it. So it could be maybe your profile is like an aggressive profile, or some of y'all could have a more defense portfolio or profile, which again you're gonna be at a safer management risk, money management, but you're gonna be earning less, and some of y'all are gonna be earning more, accepting that you have more risk as well. So again, there's no right or wrong. Oh, am I saying that just because you have an aggressive profile, you're gonna be more prone to blowing up your money and losing it all? Depends. Could be, or it could not be. It really depends on what you're doing. It depends on your strategy. Depends on how many stocks you have. Depend on if you're diversifying your money or not. So there's a million variables that I could talk about. But again, there's no right or wrong. Okay, it really depends on your type of investment, the type of investor that you are. So let's read about it. So the aggressive portfolio. So in aggressive portfolios, investors take a greater risk in search of higher returns. Aggressive investors seek out companies that are in the early stages of their growth, and most of them are not yet common household names. So again, they're not former companies that have made their name in the stock, and sure thing they could pay a little more. They have a higher probability of a probability that they're going to pay more, but they're also not too safe because they haven't proved their value yet to the market. So stocks is an aggressive portfolio experience, a higher fluctuation in price. And then you could have a defense portfolio, for example. So stocks in a defensive portfolio are isolated from huge market fluctuation. In this type of portfolio, the strategy is to bring down risk. So if you have a low risk tolerance, you can build a defensive portfolio by investing in companies that produce staples for everyday life and consumption, which are a little bit more stable and a little bit more consistent than having aggressive portfolio. So it really comes down to this. Some people, they do both. They do either, they have like some people, they do like this. They have a certain amount of income, and then they spend, let me put it away. So like 80% of their income are in stocks that are a little bit more consistent, and then 20% of their income, of their net worth, they put on more aggressive portfolio. So they're creating a balance in here. So even though they're investing in an aggressive portfolio, they're putting less money, and then most of their money goes to a company that produces staples, again, for everyday life, a consumption. So they're a little bit more consistent, and it creates a balance in here. But again, it's not right or wrong, and it's not what I'm doing. It's not what I'm telling you to do. Okay, it's just educational purposes, and it's something that people do as well. I've seen people that does this. I've seen people doing that. I've met a lot of people that does this. People that does this, or people that do this. I'm not sure which one's the most right, but yeah. Correct me, whichever is better, whichever is the right. So income portfolios focus on investments making money from dividends or other types of wealth distributions, which is one of the best ways that I prefer. Okay, I think is really good. Such portfolios include investments in assets in companies that return chunks of profits to their shareholders, thus generating a constant positive cash flow. This is really good. Okay, this one's really good, but you need to have a lot of money for this to have a consistent amount of net worth per month. Okay, to, I don't know, maybe cover up all of your expenses. You need to have a solid net worth, and most of y'all don't have it, or you're still building it. But again, you need to start somewhere. So start with what you have. Okay. Speculative, is this right? Portfolio. So speculative portfolios carry the highest risk among all types of portfolio. This type of portfolio plays an initial public offering, so it's IPO, and stocks of technology and healthcare companies that are in the process of new breakthrough projects that need funding. So this is more speculative, and you shouldn't put all your money into speculative portfolio, because again, you're putting your life into something that you have absolutely no guarantee that's going to happen. And I'm not saying that other things are going to guarantee, because there's no guarantee in stock market, but at least you have a little bit of more or more safety when it comes to other things. But again, it could be a strategy as well. You can invest here, but you have to be careful what you're doing. So again, all of these types of investments right here, you have to, they work, they could potentially work or not. It really depends on what you're doing and your knowledge and a couple of other things. And last but not least, hybrid portfolio. So a hybrid or hybrid, I'm not sure. Hybrid portfolio offers a great deal of flexibility. Hybrid portfolio allows you to indulge in other investments beside the stock market, such as investments in art and real estate. Hybrid portfolio offers diversification across several asset classes, consequently resulting in instability. So again, he talks about all of the types of investments in here in portfolios, and then lastly, how to create and maintain a portfolio. So diversify. We talked about diversification in this YouTube channel already. Minimize investment turnover. Also, try to decrease the frequency that you buy and sell assets. Most of them, they just leave it there. So if you buy a stock, that's what they're saying. That's what he's saying here. Just buy a stock and leave it there. Don't try to buy and sell all the time, because that's going to increase your transaction your costs. And plus, if you don't want to become a trader, you're just going to be a holder. It doesn't work like this. If you want to be an investor, a truly investor of a company, you don't care whether the company is increasing its value or decreasing its value. You just care about the monthly dividends, for example. Okay, so that's what he's trying to say here. More example. For example, make regular investments. So at the end of the day, it's your choice to invest in what you see important of worth your money. Or worth your money. The most important thing here is to invest incrementally on a regular basis, so weekly or monthly. This will help you achieve your goals and won't put a strain on your liquidity. So that's key thing, is what he say. And then the last one right here is to determine the objective of your portfolio. So what is your goal? What do you hope to achieve? How long do you want to achieve what you want to achieve? What's actually, realistically speaking, the amount of money that you can put in every month into building this portfolio? How much can you spend? How many hours of your day or of the week or of the month can you learn about your portfolio, and how to develop a better strategy, and how to become somebody that understands this, so on the long term you can be retributed from it. So it all comes down to this. Okay, guys, so that's how you can create a successful portfolio. I hope this video was insightful in some way. I know I talked a lot, but again, I'm just trying to give you all the knowledge in the world so you can build your own portfolio and start building your life, have multiple streams of income, so you can live a better life for you in the future. It's all about living a better life. That's all we're here for. Okay, it's not just about the money. It's what we're gonna do with the money, right? You want to give a better life for your family. You're gonna give a better life for your spouse, for yourself, for your kids, for your children, whatever. I don't know. Maybe you want to make a change in the world. It all comes down to this. So I root up for you. Hope you can do this, and subscribe for more. And I'll catch you on the next video. Have a good one. Bye.